Hi, everyone. Welcome to the Get Sharp podcast presented by Omega Point. I'm Omer Cedar, CEO and co-founder of Omega Point. We've created this podcast to help our investor community quickly form an understanding of some of the most relevant topics impacting institutional investors in the current market environment. Today, I'm joined by Melissa Brown of SimCorp to discuss the AI theme. In particular, what do investors actually own when they hold baskets or ETFs aiming to capture this theme? So look, the purpose of this podcast and what we wanted to focus on today was really to understand and do a little bit of a deeper dive into how investors are looking at quote unquote AI, right? It's a big theme, it's a big trend. Of course, everyone knows that, but how people are actually thinking about it from the perspective of getting either exposure to it or understanding their exposures to AI. And the benefit here is that through our combined kind of platforms, Omega Point and SimCorp, Axioma, of course, the risk models, we can really see some interesting insights develop around sort of AI. And so what I wanted to do is to start by talking a little bit about how we're looking at AI, and in particular, what are the types of, if you will, either baskets or, people are probably looking at ETFs or baskets that are provided that highlight different subcomponents of that. Then we'll spend some time thinking about, okay, when you're thinking about the different sub-themes of AI, what exactly are you looking at? And in particular, if you wanted to be more on the power side, right? Real estate, power and utilities versus the adoption side, where it's more of the software or maybe the application side, how are you thinking about it? What are the types of exposures you have? And so on and so forth. So that's sort of the kind of the format for today. Melissa, not to put you on the spot at the beginning, I'd love to have you sort of open it up and maybe talk to us a little bit about the different variations and flavors of AI and how you're thinking about it.
Well, yeah, and I think anybody who's investing in AI is, clearly doing so with an expectation of higher than average returns, right? So, that's why even the major indices have been so AI focused, and that's why we're all talking about it. But as in any good investment, you can't just look at return without understanding the risk that you're taking to generate that return. And so that's what we hope to get at today by looking again at, these different flavors of AI. I think the generally lately people have thought, well, okay, AI equals NVIDIA. And maybe, it's been expanded out to a few more names. We've got the Magnificent Seven, the Fabulous Four, or whatever, but it's been a relatively small number of stocks. But in fact, AI obviously has a lot more impact across markets, either, for companies who are adapting AI, other companies who are benefiting, like, power generation. I was very surprised to see how well utilities have done this year. They're actually the second best performing group of the year. And I think a lot of that ties back to the fact that all of this AI has to be powered by something, and it's powered by electricity. And so that's really been reflected in the performance of electric utilities. So AI does go beyond just a few names and really, kind of permeates everything we do. I kind of think back to, the internet when there used to be a few internet companies, but now, as we all well know, the internet permeates everything that we do. So maybe there's an analogy there as well.
Yeah, no, for sure. And I think, if we kind of think about it a little bit more from the perspective of how maybe investors can look at AI and chunk it into maybe sub themes. And actually, Melissa, your point around the internet, it makes a lot of sense, right? At the beginning, people cared about Cisco and they cared about Netscape, right? It was basically, those were the things. Okay, you had a company that was obviously delivering internet. And oh yeah, maybe there was AOL as well, right? I mean, the big days of AOL, right? Dial up and whatnot. But the reality is, and by the way, we're probably both dating ourselves as well when we're saying that. But the point is that when we're thinking about the world of AI, today, if you use the same analogy of the internet, right, you're seeing that there is definitely a lot of focus today on basically the infrastructure. Everyone understands that in order to actually be able to deliver it, you're going to need to have the infrastructure players really solidified and built. And so, to Melissa's point, it's not just the NVIDIAs who are essentially have the GPUs, and of course, the Microsofts or the Googles who are basically building the giant sort of data centers. and are implementing sort of foundational LLMs or whatnot. You also have the electric power producers, you have REITs, and so on and so forth. And those are really another component of infrastructure, which is maybe one step removed, but it's definitely benefiting quite a bit, given the need to basically upscale, right? The amount of power needs, the amount of obviously real estate needs for these large scale data centers, which have not been prior designed, right? So investors are obviously looking at what's the delta between today and what we're looking at in the future. Well, all of a sudden, any REIT that is involved with data centers is probably looking at uptick in demand relative to what was projected. The same thing, obviously, with power. And so in those two cases, you have almost these two sub themes that play out there. And then to Melissa's point, then obviously downstream, eventually, you think everybody's going to be doing some form of AI. Well, most of them are going to be on the adoption side, right? They're not going to be, there will be a few potential tech infrastructure providers and power producers and REITs, but you're not going to have thousands and thousands of them, but you are going to have thousands and maybe tens of thousands, if not maybe hundreds of thousands of companies that are doing some kind of form of AI adoption, right? And they're basically embedding it into some kind of a workflow or business process. And to that end, I wanted to kind of migrate the conversation to one of our mutual partners, small firm named Morgan Stanley, most people know, has actually developed certain types of, if you will, sort of indices that investors can get access to, either from the perspective of looking at AI, again, infrastructure on the semiconductor and data center side, on the power side, so power producers and the REITs around it, and then around the adoption side. And what I think we wanted to talk about today was how the different components or the different sub-themes really are looked at from the perspective of risk. Obviously, all of them have had good returns over the period of time, but to Melissa's point, you really need to understand what are the go-forward risks of owning those. So
And
maybe we can
I
start
think
with
it's
that.
true with any type of thematic investment
Right.
that you need, if you're going to buy it and add it to a portfolio, you need to understand the risk and what it does to the risk of your existing portfolio. And, I think Omer and I have looked at these different baskets or thematic indices and, realize that there are some risks that you may expect, and there are some risks that you may not really have been fully aware of.
Yeah, and I think to your point, Melissa, it's interesting to kind of see how through the lens of the Axioma model, right? And here we're using one of the newer ones, or the newest US model that has, I think, some interesting also characteristics around hedge fund crowding, short interest. It has a new factor that, Melissa, I think we'd love for you to talk about, called downside risk associated with that. But some of these new factors are actually highlighting some really, really interesting results, right? Or some interesting insights. For instance, if we're thinking about the, starting with like maybe the more traditional sort of NVIDIA semiconductor group and data center group, right? Where I think we were taking a look at some of those factor exposures, and we were noticing that, for instance, obviously one would expect, yes, momentum is high, the stocks have done well. We kind of recognize that across the board, but we also noticed, interestingly enough, that when you look at things like, crowding and short interest, right? And in particular in the area sort of crowding and short interest, we're not actually seeing as much crowding and short interest today on the semi and tech infrastructure beneficiaries as much as the actual AI adopter side. So AI adopters, if you think about those have a lot more software, capital markets, IT services, banks, healthcare, right? We're actually seeing a lot more sort of crowding going into those. So it's maybe a suggestion that investors, they understood months ago, yes, it was the NVIDIAs and the Microsofts, and now people are moving on. And they're saying, okay, I'm actually thinking about what's the next stage of AI. How should I be looking at that? So from the perspective of actually crowding, what we found that's kind of interesting, in particular in these sort of AI, I guess, adopter side, that there's actually a high hedge fund crowding, or maybe more of a crowding, and also a high short interest, right? So think about the idea that, like, typically, these are long only baskets. They're representing basically names. It seems like a lot of folks are either sort of feeling very good about them. They're thinking, hey, I should be really positive these names. I should be putting more of my capital into them on the long side. But there's also a little bit of a battleground where people are actually putting also capital in on the short side too, and are noticing that and so that's sort of happening more, I would say, on the AI adopter side, a little bit less so for what we're seeing on the semiconductor and infrastructure side. But certainly if we look at sort of the power one, which is maybe the one that people sort of have seen, to Melissa's point, a lot of movements in the last couple of months, we're definitely seeing that there's a lot more crowding on the long side there. So people really believe on the power side, it's really a bit more of a long trade, and there's not as much short crowding on the short side. So it seems like on the short side, people do not think that there's much of a battleground between those.
And I think if you go back to the infrastructure semiconductor basket, I mean, many of those stocks have become the market. They're, they've got huge weights in the US market. And, therefore, it's very hard to be overweight those stocks. And I think, hedge funds do tend to be more forward thinking. And so it's not that they're, uncrowded, that there's, everybody's out of those stocks, because obviously you have to be in them if you're in the market. But maybe for particularly as a hedge fund, where you want to place your bets is outside of those well-known names that are in the newspaper every day. And so that's why you can see some of that crowding impact. It's also this difference between, the two sets of baskets, where one sees both high crowding and high short interest. So there's definitely disagreement there. Mm-hmm. Versus the basket where you do see more crowding. That, does suggest there is more agreement on that set of stocks. And by the way, I should point out that we expect stocks that are highly crowded to do well. So crowding has a positive risk associated with it. Short interest has a negative risk premium associated with it. So short sellers are typically right. And so stocks with high short interest tend to underperform. So just wanted to make sure that we, outline that, just so when we talk about these factors, it's sometimes good to have high crowding. It's bad on the long side to have high.
No, appreciate that. And there's another factor that's interesting, and we're noticing is actually in terms of being common across all of those. Of course, again, we mentioned you would expect momentum to be common, and we're aware. I mean, there's a lot of research showing momentum, generally speaking, over time. It's good to be long momentum. So that's definitely a common across all of those. But one factor that might have also some little bit of a headwind against these types of these sub-themes, if you will, and this is really across all three, we notice this, is something called downside risk. And again, this is a new factor that has been introduced into the new Axioma model. So maybe, Melissa, you can help us understand, what does downside risk mean? And historically, what does that premium look like on that factor?
Yeah, thanks. So, without going into all the, detailed equation of how we calculate the factor, downside risk is focused on semi-variance, or the bad side of volatility. So if you think about it intuitively, upside volatility is a good thing. Generally, nobody complains if a stock goes up a lot. It's only if it goes down a lot that it becomes a problem. And so that's what we're trying to capture there, is that downside risk. What's the likelihood that this stock is going to have a big downward? We have, studied this, as we build our factors, we built this factor back to 1982 and found that this factor has a very negative risk premium associated. So that if you have high downside risk, a high likelihood of having, a lot of bad days, that tends to lead to underperformance of stock. And again, going back to the intuition, because investors don't like having those bad days. And so when we look at these baskets and see that they have a positive exposure to downside risk, that's, perhaps a note of caution on these baskets of stocks. It's not surprising. All of these stocks tend to be volatile. And so, we do, if you look at NVIDIA it has big moves every day. Sometimes they're up and sometimes they're down, but they're often quite large compared to many other stocks. And so it's not necessarily surprising that these baskets, or at least the semiconductor and infrastructure basket, has a high exposure to downside risk. Maybe a little more surprising to see the utilities related basket, because utilities typically are not thought of as having, high volatility, either upside or downside. And then the adopters basket also, I mean, that's much more well diversified because it's got stocks across many different sectors and industries. And so you would expect a little bit less volatility in that. But so it was, again, a little surprising to see a higher than average downside volatility in that basket as well.
Yeah. And I think this is actually a sort of a good kind of a maybe segue into sort of thinking about how to manage these exposures, right? I mean, again, these are themes that broadly speaking, people believe are going to outperform the market. It doesn't mean that every possible component of that theme, when you break it down into its sort of set of risks, are going to outperform, right? There are going to be sort of tailwinds and there are going to be headwinds. And I think what we're highlighting here are maybe some of the headwinds that people should be aware of. Obviously, short interest being one of them, downside risk being the other. Melissa, what have you seen, or how do people sort of use those factors, to maybe, or what can they do, I guess, to be able to ensure that that exposure that they are taking on doesn't contain maybe those sort of headwinds against the portfolio?
Well, there are certainly, other baskets that can be used to hedge against that exposure. So, many vendors offer, for example, momentum baskets, and you could short that basket. So you're hopefully shorting out as much as possible your momentum exposure. Now, you wouldn't necessarily want to short that because with the momentum has a positive risk premium. So you wouldn't necessarily want to erase that exposure. But there may be other exposures. As Omer said, this US model, or US 5-1 model, is new. So there may not have been baskets set up that maybe are downside risk baskets. But, certainly within Point software or within the Axioma software, it certainly is possible to set up hedges against, where you minimize the exposure to factors. And we said that's what many of our clients do. That's how they use our products. And I believe, or correct me if I'm wrong, that's how many of your clients use your products as well.
Yeah. Well, in general, I think, it's definitely not, there's not one, way to get rid of these exposures that you may not want, the unwanted exposures. And I think, to your point, Melissa, is the benefit of certainly working with broader platforms that have access to various approaches allows you to it's a little bit of a choose your own adventure, right? And what we're finding is that maybe if you're more core on the fundamental side, you might say, well, I still want to keep as much of the exposure as possible. I don't want to be adjusting the names that I already own, but I'm doing research, and my analysts, right, should be aware that maybe in their new research that they're doing kind of incrementally on different companies within those sub-themes, they should be trying to find ones that don't have as much downside risk exposure, maybe that have not been as elevated as the others. So in general, you want to be reducing your average, right, of downside risk when you're looking at these types of names. Obviously, there's an opportunity if you believe that there's some of them are maybe overvalued or maybe are AI pretenders. Even if they've been able to swept up and you're seeing high downside risk there, then you might actually want to examine them for potentially a short portfolio if you're on the long short side. I think that on the fundamental side, oftentimes when the analysts get involved, there's a nice way of being able to do some of that type of deeper analysis with the understanding that these are characteristics that you want to be more thoughtful around. And then, of course, as Melissa said, I think on the hedging side, if the goal is, okay, I'm happy with my portfolio. I don't know if I'm going to be able to find other names that I'm going to put into the portfolio that are going to offset them, but I'd like to have something a little bit more systematic from a hedge basket perspective. Then there's, of course, approaches to build much more pure factor-oriented hedges that involve 300, 400 names or more potentially. But they're highly diversified. The point is that they're not going to expose you to other factors. They're going to try to expose you to just the factor that you care about on either the long or the short side. And so again, there's opportunities to use these optimizations tools, or I think over time, I would imagine that our bank partners are probably going to come out with some baskets that will help, provide some turnkey tradable solutions for these factors.
And then, I think just one more consideration is if you're going to add these kinds of stocks into an otherwise diversified portfolio, the added factor exposures, I mean, you certainly want to measure them and check them, but maybe they're going to be diminished a little bit because of what you already own. So, as we always say, you want to look at the, risk of your total portfolio and make sure that it's in line with your expectations. I would say risk in and of itself is a good thing. Without risk, there's no return. You just want to understand it and make sure that it's aligned with your return expectations.
That's wonderful. This is actually, a good place to end it to this one. The goal is to keep these short and sweet and help you understand some of the key components. Always, if you have any questions, feel free to reach out to us. But we're excited to have started this inaugural podcast together and look forward to doing many more. Thanks so much, Melissa.
My pleasure.